Hello there, welcome to our channel. This video explains the long collar position in simple terms. So let's get going. The long collar position has three components. That is, the investor takes three positions and closes the three positions simultaneously sometime in the future. And what are the three positions? Presuming that the underlying is a stock, the investor takes a long position in a share. That is, he holds long position in the shares of a company. He owns the shares of the company. The long position in an out of the money put. That is, the strike price of the put option is below the current market price of the share. And the investor holds a short position in an out of the money call. That is, the strike price of the call is above the current market price of the share. The expiry of the options is the same, and the options exactly cover the number of shares owned by the investor. So the investor is long shares, long an OTM put, and short an OTM call. Now the put premium can be greater than or less than the call premium. If the put premium is less than the call premium, it is a net credit situation because the investor receives more premium for selling the call than he pays for buying the put option. If the put premium is greater than the call premium, it is a net debit situation. Let's first look at a net credit situation. For example, let's say the investor has bought 1,000 shares of XYZ Limited at $100. He takes a long position in 10 lots of the 95 strike price put. Each lot covers 100 shares. So in total, all the 1,000 shares are covered. The premium of the put option is $5 per share. This is the amount he pays per share for buying the put option. He takes a short position in 10 lots of the $105 strike price call option, with each lot covering 100 shares. So again, all the 1,000 shares owned by the investor are covered. The premium is $6 per share. This is what the investor gets when he sells the call option. Note that the expiry of the call and the put are on the same date, say 3 months from today or 6 months from today. To recap, the underlying buying price is $100. The put strike price, the long position, is $95. The call strike price, the short position, is at $105. The put premium, which is paid, is $5. And the call premium collected is $6. Therefore, there is a net credit of $1. Say the investor closes the positions, that is all the three components, on the expiry date. To calculate the profit and loss of the investor, one needs to calculate the profit and loss in each component and total them up. Let's say the underlying is 110 on expiry. In that case, investor will make $10 per share in the long shares position because the closing price is 110 and he bought it at $100. So that's the profit, $10 per share. The put will expire worthless as its intrinsic value will be zero. As we know, the intrinsic value of a put option is the strike price minus the market price of the underlying, subject to a low limit of 0. For a long put position, the intrinsic value of the put option is $95 minus 110, which is basically 0. So the investor will lose money in the position, that is, he will lose $5, which is the premium paid. This is his loss if the underlying closes at $110. The call option will be in the money because the intrinsic value of call option is the market price of the underlying minus the strike price, which is $110 minus $105. Hence, the call buyer will exercise the option and our investor, who is a call seller, will lose $5 per share. However, since he made $6, he collected this premium, his net profit will be $1. The loss in the short call position will be offset, more than offset, by the call premium collected. Hence, the total profit or loss of the investor, it's a profit in this case, will be $10 minus $5 plus $1, which is $6. And what if the underlying is $120 on expiry? The profit in the long position is $120 minus $100, which is $20 per share. Loss in the put position remains at $5 per share because the put expires worthless and the premium paid is a cost. For the short call position, the net result is $6, which is the amount received, minus $120 minus 105, which is $15. This is by how much the call is in the money. Therefore, the investor is going to lose $9 per share. If we total these up, $20 minus $5 minus $9, it is a profit of $6. Hence, the profit remains the same, whether it is closing price of $110 or $120. That is, the profit gets capped because of the short call position, as whatever extra one makes in the long share position is offset by the loss in the short call position. The loss in the put position remains the same at the premium paid if the intrinsic value is 0. So one feature of the long caller position is the capped upside because of the short call position. Let's consider two cases where the underlying closes below the put strike price. Let's say the underlying closes at $90 at expiry. Now the long share position is in a loss, the put position is in the money, and the call option expires worthless. Let's calculate the profit or loss of the three components. The long position is in loss. The net result is a $10 loss because the underlying price is $90 and the purchase price was 100. The intrinsic value of the put option is the strike price minus the underlying price, which is $95 minus $90, which is $5. This is the investor's payoff. However, he paid $5 for buying the option, hence his net profit loss is 0. Makes 5 in the put position, but he paid $5 premium. So it's a break-even situation. The call option expires worthless, that's intrinsic value is 0. Basically, $90 minus $105 is negative, hence the intrinsic value of the call is 0. Hence, the investor's profit is the entire premium that he initially received while taking the short call position, which is $6. Therefore, the net profit loss in the long caller position is equal to minus 10 plus 0 plus $6, which is a loss of $4. And if the underlying goes further down to $80, the loss in the long position will increase to $20. The gain in the long put position will increase to $10. And the gain in the worthless call option will remain at $6. The total net loss will be minus 20 plus $10 plus $6, which is minus 4, which is a loss of $4. Therefore, the net loss is also capped in a caller position. To visualize this, let us look at the graph of the long caller position with a net credit. The solid line is the total effect of the three positions. So, the investor is able to protect his downside at the cost of capped upside while maintaining the long shares position in the shares. Note that the short call pays for the long put and the investor essentially protects the downside in the long shares at no cost. In fact, with a credit of $1 in our example. However, this cost cutting comes at a cost. The cost is the capped upside. Let us consider two cases in which the underlying closes at a level including and between the two strike prices on expiry. In our case, underlying closes anywhere between $95 to $105. Both $95 and $105 are included. In such a situation, both the call and the put will expire worthless. So their combined effect will be the initial net credit or if debit if that were the case. First, let us presume that the underlying closes at $98. The loss in the long position is $2. Both the put and the call expire worthless, leading to a net effect of minus 5, the put premium paid, plus $6, the call premium earned, equal to $1, which is the net credit. As a net result is that the investor loses $2 in the long shares position and makes $1 in the option positions. So net loss of $1. Suppose the underlying closes at $102. In that case, the gain in the long position is $2. And again, both the options expire worthless, resulting in a net gain of $1. Hence, the total gain of the investor is $2 in the long position in shares and $1 credit which he received for the options. That is a $3 profit. At 99, a special case, the investor breaks even as his loss $1 in the underlying is offset by the $1 net credit received at inception in the two option positions. Therefore, the break-even point is basically the initial cost of setting up the three positions, which is $100, the cost of buying the shares, minus $6, which is not a cost, which is actually a profit, a gain of the premium which was received while setting the call option, plus $5, which is again a cost of buying the put option, which is equal to $99. So we know that the maximum profit is $6, the maximum loss is $4, and the break-even point is $99. Obviously, one receives the credit if the cost of the put is more than offset by the premium received in the short call option. That is, the premium of the call option is greater than the premium of the put option. Suppose the premium of the put option is greater than the premium of the call option. That is, the investor receives a net debit initially. He pays more for the long put position and receives less for the short call option position. In that case, the break-even point will be above the initial buying price. Let us see the net debit cases quickly. The investor has bought 1,000 shares of XYZ Limited at $100. He takes a long position in 10 lots of $95 strike price put. Each lot covers 100 shares. The premium is $6 per share. He takes a short position in 10 lots of the $105 strike price call option. With each lot covering 100 shares, the premium is $5 per share. The initial debit is $1 because he pays more for the put option, $6, and he receives $5 per share while selling the call option. If the underlying closes at $120 on expiry, the investor's net position is as follows: a $20 gain in the long shares position, 120 minus 100, a $6 loss in the long put position as the put expires worthless, $105 minus $120 plus $5, that's a minus 10 loss of $10 in the short call position as the loss in the short call is partially offset by the initial premium received. On a net basis, the investor made $20 minus $6 minus $10, which is $4. This is the maximum profit that the investor can make in this caller position. Now, if the underlying closes at $80 on expiry, the investor's net position is a loss of $20 in the long shares position a gain of $9 in the long put position as the put is in the money, but the price paid for the put reduces the net profit in the position. Basically $95 minus $80, $15 is the intrinsic value of the put option, but the investor paid $6 for buying the put option, hence his gain is reduced from $15 to $9 because of the $6 premium paid. The call expires worthless and the investor profits $5 from the initial premium received. So on a net basis, the investor loses money as follows: $20 loss in the long shares position, $9 gain in the long put position, and $5 gain in the short call position, a loss of $6, which is the maximum loss. The break-even point is at $101 because at $101, the $1 profit in the long shares position will be offset by the $1 initial debit. Let's look at the graph of the long call position with a net debit. The solid line is the profit or loss. The loss is capped at $6. The profit is capped at $4, and the break-even point is at 101. Instead of finding the maximum profit, maximum loss, or break-even by hit and trial, one can use the following three formulas. The maximum profit is the call strike minus the underlying buying price, plus the call premium received minus the put premium paid. This is understandable because in the underlying buying price to the call strike price range, which is an upward movement, the call will not be exercised. Hence, if the underlying is at the call strike, the sum of the profits in three positions will be at the maximum level. Beyond the strike price, any gain in the underlying long position will be offset by the loss in the short call position. The maximum loss formula is put strike minus underlying buying price plus call premium received minus put premium paid. This is understandable because in the underlying buying price to the put strike price range, a downward movement, the put option will not be exercised. Hence, the put will not be able to contribute to the profit. Hence, if the underlying is at the put strike level, the net effect of the three positions will result in the maximum possible loss. Below the put strike price, any loss in the long shares positions will be offset by the gain in the long put position, limiting the downside. The formula for the break-even point is as follows. Break-even point is equal to the underlying buying price minus the call premium received minus put premium paid. The break-even point is basically the initial cost of setting up the three positions. That is $100 minus $6 plus $5, which is $99. Note that we are ignoring any time value in the options because we are presuming that the positions are closed on the expiry date. Profit losses may be different otherwise. Now the three components of a long collar position can be rearranged to see the collar in a different light. To recap, long collar involves three positions: long stock, long OTM put, short OTM call. This is equivalent to a covered call, which is basically a long stock plus a short call plus a long put, or a protective put, which is a long stock plus a long put plus a short call, or a synthetic short stock, which is a long put plus a short call plus a long stock. And why does an investor execute a collar? Basically, he wants to hold on to the long position while protecting the downside at a limited cost. This is because the short call pays at least partly for the long put. However, this cost saving leads to a capped upside, as the collar is suitable if the investor is bullish on the stock in the long term but sees some possible downside in the very short term. So he doesn't want to sell the stock. Also, he does not foresee too much upside in the short term, else there was no need for downside protection. A quick look at the deltas. The long shares position has a delta of plus 100. The long put and the short call positions have negative deltas, same minus 17 total. Therefore, the combined delta of the three positions of the collar position is a much lower delta than plus 100, say around plus 30, indicating reduced loss and profit potential. This concludes our video on the long collar position. We hope that you can now calculate the profit loss and the break-even point of collar positions easily. Thanks for watching and happy learning.